Monday. This is Jay Brew, co-chairman of Seafried and Brew. An interesting article appeared on Bloomberg last week, and it was called Rally Round U.S. Treasuries. It was an opinion on Bloomberg written by A. Gary Shilling, who is a consultant and money manager. And the thing that struck me as interesting was that he was bringing up the same points that we've talked about in prior webcasts in terms of what would keep rates low and most likely keep rates on the 10-year U.S. Treasury below a 1-2% level. So when we look at this is that once again, and we've looked at this before, that U.S. Treasury 10-year 195 today, Germany 0.21, Switzerland negative 0.05. But he also brought up in the article that the Spanish 10-year 1.27, Italian 1.31. Amazingly enough, now lower than where the U.S. Treasury is at a 195. Think back, amazingly enough, when these countries were having financial trouble, their rates soared, but have now come down below our rates. And when you compare the economies of these countries to the U.S., it's amazing. He notes how high our Treasury is, and another reason it should be moving downward in here. He also talked about hourly earnings, that the majority of jobs that have been created out there have really been low earning type jobs that have not really put any kind of pressure on wage inflation, which the Fed is getting concerned about. He also talks about inflation. And of course, when we look at the PPI and how the PPI has really come down dramatically in here, is that we could be looking at, similar to Japan, long-term, low inflation, maybe even, as we've discussed before, disinflation. So one of the things that he brought up, which I thought was interesting, which we haven't talked about, is that this is the last 12-month issuance of U.S. Treasuries, and you can see that it's been on a constant move down. So there's less Treasuries in the system than what there were a year ago. And he feels that with foreign buying and with stepped up foreign buying of U.S. Treasuries in here, that can also put a downward move on all the U.S. Treasury market. So when a different way of his perspective in terms of thinking about where interest rates are going to go was kind of amazing when you got to the point where he actually made his prediction on where the 10-year will trend to. So what is his prediction? Amazingly enough, we're at 1.95% in here right now on our 10-year. He is anticipating that we could see the 10-year go down to 1%. And though that may not seem right now probable, but interestingly enough, with that kind of argument, there could be a possibility of that happening. Have a great week. This is Jay Brew, co-chairman of Seafried and Brew.